Conventional mortgages. I know you've heard of them, but today we are going to dig into exactly what they are. I'm Caroline Reed with The Real Deal, where we give you the confidence and the clarity that you need to make the right real estate decisions for you. And today we're going to talk about the ins and outs of a conventional mortgage. The most basic definition is a loan that is not backed by the government. It is backed by the individual bank. FHA loans, VA loans, USDA loans are all government-backed loans. The government has said we will take the risk for those loans. If somebody defaults, can't make those payments, we, the government, will pay you, the bank, and make you whole. In a conventional loan, that risk of loss is on the bank. But it is still the most popular loan, accounting for 3/4 of all home loans. And because the bank is taking on that risk themselves, these loans are sometimes a little harder to qualify for. You need a credit score of at least 620 at the least. In fact, it has to be up around the 740 range for you to get the best interest rates. But unlike government-backed loans, you can use a conventional loan to buy a house that is not your primary residence. So if you want to buy a rental property or like a vacation home, you can do that. In fact, you can get a single family home, townhouse, condo, 2 to 4 unit rental properties, or other investment properties. And there is no income requirements for a conventional loan, but there is something called DTI, debt to income ratio. And if you want more information about that, you can click right up here. For a conventional loan, that's going to hang right around 43%, but you might be able to push that up to 50% with some certain mitigating circumstances. If you have significant cash reserves, like after your closing costs, if you still have like the next 3 months worth of payments in the bank, that's one factor. If your new mortgage is going to be about the same as your current mortgage or housing payment, that's another factor. Or if you have significant income that you haven't used to qualify, like income from a second job or something like that. Now, for a conventional loan, you also need to have some assets. Basically, you have to prove that you have enough money in the bank to cover your down payment and your closing costs. And the loan limit on a conventional loan is the same as FHA. It is about $548,000, but those do vary depending on what parts of the country that you're in. If you're in a higher expense area like New York or San Francisco, those loan limits do go up. So you certainly can go online and find out what those loan limits are for your individual county. Now, there are two types of conventional loans, and the ad is conforming and non-conforming. A conforming loan is one that meets the FNMA and FDMC, Fannie Mae and Freddie Mac, which meets their guidelines. And the bank has to meet those guidelines if they want to resell that mortgage to Fannie Mae and Freddie Mac later on. Or the other kind is a non-conforming loan. Non-conforming loan is one that doesn't meet those Fannie Mae, Freddie Mac guidelines, which would be more like if you need a jumbo loan, a loan that goes above the loan limits that we mentioned earlier. Or if you wanted to buy a vacation property or an investment property, maybe a rental property. Now, most people think that you need to have 20% down to get a conventional loan, and that is not true. You can actually get a conventional loan as low as 3% or 5%, anywhere in the range up to 20% or higher if you want. Now, the 3% option is called the conventional 97, but that one does have some caveats. At least one person buying the home has to be a first-time buyer. And they define first-time buyer as anybody who hasn't owned a home in the last 3 years. It must be a primary residence, and you can't use it to buy a multi-unit property. So you can't buy a duplex and rent out the other side. Now, what are the pros to a conventional loan? Well, one of them is that you have faster processing time because you don't have the government agencies that you have to go back and forth with the government-backed loans. The bank can do it all in-house and it usually gets done a little quicker. So quicker time to closing. You have more flexible terms with a conventional loan. Government-backed loans are generally 15 and 30 year, and you can get adjustable, but you're still stuck with those 15 or 30 years. Conventional loan, you can get terms anywhere from 5 to 30 years and anywhere in between. Plus, they also have those adjustable options. And like I said before, it doesn't have to be your primary residence. You can use it to buy a vacation home or a rental property, or if you want to buy a house and fix it up and flip it as an investment, you can do that as well. The property just has to appraise for the amount of the loan, and you still have to qualify with income requirements and things like that. And it has lower fees. An FHA loan has an upfront mortgage insurance premium of 1.75% of the loan amount. And a VA loan has a funding fee of 1.4 to 3.6% of the loan amount. And while the government-backed loans actually have a pretty good interest rate, it is possible to get an even better interest rate with a conventional loan because the interest rate drops with a higher down payment and with a higher credit score. And probably the best reason to get a conventional loan is private mortgage insurance. If you put a 20% down payment on a conventional loan, you will have none. If you put less than 20%, you will have some mortgage insurance that you will have to pay. That amount that you have to pay depends on how much you have down and your credit score. But you can also have that mortgage insurance removed when you get to 78% of a loan to value ratio. Now, if you compare that to an FHA loan, FHA still has mortgage insurance, but if you put less than 10% down when you get that loan, that mortgage insurance premium never goes away ever. And if you want to refi out, you can certainly do that, but there are fees to doing a refi. Or if you do manage to put over 10% down, it still hangs on for 11 years, no matter what your loan to value ratio is. So if you are studious about making your house payment and you add a little bit more to it and you hit that 78% in 6 years, sorry, you still have another 5 years to go. Now, there are cons to a conventional mortgage, and the biggest one is probably that it is harder to qualify for. It has stricter standards. The bank wants to know that since they're risking their own money, that you actually qualify for this loan. So the DTI requirements, it's possible that those are going to be tougher to meet, and you could be facing some potentially higher interest rates than if you went with the government-backed loans. One thing that is not a con is to go right down below and hit that like button. So probably one of the most popular questions is, how much should I put down? Well, I hate to tell you, but that is far too complex of a question to answer. That is a discussion that you need to have with your lender. Your lender's going to have all of your financial information, and they can walk you through what the different scenarios would look like in terms of how the changes would affect your monthly payment. Just know that the higher your down payment, the lower your PMI is going to be, and the higher your credit score, the lower your PMI is going to be. Click right here if you would like more information on the ins and outs of an FHA mortgage, and go ahead and click right here if you would like to see a conventional mortgage and an FHA mortgage side-by-side comparison. Thanks for watching. See you next time.